All right, welcome to the lead intro to trading, electronic trading systems. A couple of disclaimers beforehand. If you need me to slow down or repeat anything, feel free to jump in. I was thinking that probably we should hold questions until the end if anybody has one. There's not that many slides, so we can go through them at the end if you have any questions over it. Another thing is that I have some examples of algorithms and trades in here. I don't recommend that anybody try that on their own. If they really do, then, you know, good luck. Also, this thing is really, I was about to move the computer, but I'm scared too. This thing is actually broken up into two different sections. One is the intro into trading systems, and the second is really, there were slides and stuff that I took out as I was building this, and I thought they might be interesting that grew into the end of the sections. So that's like section 2. So specifically, we're talking about electronic trading systems, and even more specifically, we're talking about front office. What is front office? Every trading house and shop in the world has 3 major offices: front, middle, and back office. Right? Your back office are the people that take care of your account management, your corporate actions, your trade position, and cash reconciliation. A real good example of corporate actions are going to be dividends, right? If you own some share of Microsoft and they announce dividends, you know, you show up the next day and you've got more money in your account. Or if you configure your account a certain way, you've got more shares than you originally bought, right? Who takes care of all of that? That is taken care of by back office. They do the, you know, long-term view of stuff. On the complete other side of that coin, there's going to be the front office trading technologies. These are the people that, when people think of Wall Street and they think of, you know, floor traders and people with like tons and tons of high-speed algorithms and, you know, advanced mathematics, this is going to be your front office. These are the guys that deal with multiple exchanges, you know, buying and selling stuff, and oh my God, oil is going down. That's all front office guys. And then where you meet right in the middle is going to be the middle office. You know, they do T+1, which is trade date +1. Reconciliation. They do your primary reporting to any of the government bodies. They are the ones that are managing a large amount of risk because, you know, you have to wait for settlements, etc. We'll get to more of that in a bit later. Something else that is pretty common when people start talking about trade systems, there are these big, ugly things with real chatty systems, and they start throwing around words like risk and position, and you've got radio frequencies and different data centers and all of that stuff. So instead of trying to like put up a real big picture of a complex system and like grabbing individual pieces and trying to explain it, what I'm going to try to do is we're going to start with a blank canvas, and we're going to evolve out our trading system. We're going to start from nothing and sort of move into a real world trading system. Before we can do that, though, we want to talk about exchanges. Trading systems are exchanges or venues are basically places that you can buy and sell things. Buying and selling specifically financial instruments. Financial instruments are like equities, futures, options, credit default swaps, bonds, all of the different things that you guys always hear about as, you know, people moving money around. This is what they do. To make life even a little bit more interesting is the fact that these for each different kind of financial instrument, you have a different exchange. Now, each of these exchanges are actually sitting in different physical locations, some of them for historical reasons, and some of them for completely arbitrary reasons. We'll leave why they sit in different locations alone for the moment, but what is interesting to think about each of these exchanges is they each have their own language. They talk using their own protocol. Some people use binary protocol, some people use fixed, some people use stuff. It's just, it goes all over the place. And each exchange has its own notion of volume and throughput. I mean, there are some exchanges that are famous for send us as much as you possibly can, and other exchanges that cap you off at 500 messages a second. But what each of these exchanges share in characteristics is that they're regulated, they have oversight, and that they're required to follow fair trade rules. How that's determined is, you know, a subject of considerable debate, but that is one thing that all of these exchanges share. So now we know what we're buying and selling. Let's start out with building our trading systems. So in the beginning, we start out with absolutely nothing. We have a whole bunch of people that show up, and they're called traders. And traders say that they want to buy and sell stuff. We say, well, great, that's really not that much of a problem. We're going to give you an ordering interface. And that ordering interface, that ordering engine, all it does is translate between your internal and external data messages, right? It translates between your data model. It translates between how you understand instruments to be to what the exchange is expecting. And of course, it manages order state and a few other things. So traders are now very happy they can buy and sell things, and then they come along and say, well, hey, we also want to remember what we bought and sold. We want to remember when we did it, at what price we did it, how long ago we did it, who did it, what account it went into, and a whole bunch of other things. And so we introduced the position manager. And this guy basically takes care of inventorying the shares and instruments that you bought. It keeps track of when you bought it, what notional value you bought it at, and the whole, it's your accounted for the trading ecosystem. And at this point, everybody's relatively happy as well, except that you get a whole other set of traders that said, hey, well, it's really cool if these guys can buy and sell things. We want to be able to buy and sell things as well. So we say, no problem. We've got an ordering engine. We'll just give that to you. Hell, you can use the same one. They say, no, we can't do that. The ordering engines are different. So in the best possible case scenario, we're just changing a couple of configs and maybe accounts. In the worst possible case scenario, it's going to a completely separate exchange. And so now the traders are very happy as well. The second set are very happy as well because they can buy and sell things. But guess what? They also want to remember what they bought and sold. And we now have a position manager. And somebody realizes that we have two different position managers happening in the same freaking company. And they say, no. These guys have to talk to each other. One set of Microsoft actually has to relate to the other set of Microsoft. So now you have the introduction of a distributed position manager, which is something I'm sure everybody here is going to love. So after we start talking about the fact that position managers have to talk to each other, we now need to start wondering about, are we allowed to buy and sell something? Do we have the money to buy and sell something? And they're not the same thing. Allowed, there's a lot of reasons that a stock can be disallowed to buy it. Plus the fact that your account may have money in it. It may not have the money in it if you want to buy and sell that particular trade. And another thing that's not very useful is the fact that if you end up saying, I want to buy, an extra 100 million shares of Microsoft, and, a day later they come back and say, hey, well, you remember that trade that you thought you made a couple of $1 trillion on? Turns out you didn't have the money to do it. So it's null and void. And well, that doesn't really help anybody at all. So what we end up talking about when we talk about risk is, why isn't this showing up? Pre-trade risk, right? These are checks that happen before you actually send your orders to the market. So not only do we have the position managers that are now talking to each other in order to reconcile which positions you're actually dealing with, you're actually now sending messages to and from the pre-trade risk checks as well. And as you can imagine, this increases our complexity from 2 hops to 4 hops. Makes life a little bit more difficult. Something else that I also wanted to bring up is that up until now, in the slides up until now, I keep showing the fact that there's 2 exchanges. And I use that to show that it may be the same exchange, but in reality, it also may be 2 physical different locations. Oh, and also, by the way, these were brought up due to regulations. Like, it actually costs a lot of money for everybody to start doing pre-trade risk controls. And it takes a lot of time and a lot of technologists and everything else in order to unify your position management systems. So the only real reason anybody would ever do that is because of regulation coming down. And the 2 primary regulations that led to the evolution of this kind of a system are going to be Reg Show and 15C-3. You guys can look those up if you feel like it for the whole legal shebang. So back to the fact that there are 2 different exchanges. And the reason I've been talking about 2 different exchanges is because we want to bring up the concept of co-locating. Why does anybody co-locate? The answer is speed, right? If you don't really care about speed, you don't worry about co-locating. And if you do care about speed, you want your servers as close to the exchange as possible. People take this to such a degree that they literally worry about the length of fiber that connects their systems to the exchange systems. And the exchange will guarantee that your length of fiber is equal to your competitor's length of fiber, insofar as they will sit there and wind lengths and lengths and lengths of fiber to make sure that you have exactly 15.1 meters as well as the competitor. So something I did want to say about this particular diagram, every other diagram in this presentation is a logical layout. This one is going to be more of a physical layout. It's really the only one. I'll keep referring to physicalities, but in general, it's a logical layout. And the reason I wanted to talk about the logical layout is because we're talking about speed. And when you start talking about speed, you start worrying about message hops, right? So if you're going to go from NY4 to MAWA, the only real way to do that is to send your message through 111.8. And that takes time. That adds latency, right? So you'll end up having a lot of architects and designers that will pay a lot of attention to where you put servers, to where you put your message brokers, to where you put your pre-trade risk engines, simply because they don't want to add the extra latency or the extra hops. So like we know that we care about, in this instance, we know that we care about speed since we're talking about co-locating, and we know we care about hops, but the primary thing is, if you don't care about speed, if you're dealing about hedging algorithms, if you're dealing about symbology engines, if you're dealing about anything that you can possibly cache, you don't put that in the data center, you put that somewhere else that isn't so speed dependent. Examples of things that are going to take a lot of, that people are going to put a lot of thought into are things like TCP risk requests. So before I can send an order to an exchange, I actually have to get permission from my pre-trade risk engine. My pre-trade risk engine is actually sitting on a different co-location. I end up having to do a lot of unnecessary hops, the one in green's right here. That's something that we want to avoid. That's a bad case. A worst possible case is if you put your pre-trade risk engine or your message broker on site and your pre-trade risk engine is sitting in a different co-location, then it's got to travel all the way to your message broker, figure out what it's going to look for, travel all the way to the separate co-location, turn around and go back and do the whole, and do the whole thing over again. This is one of the reasons, like I said, that people end up paying a lot of attention to architecture, not just the logical view of things. So, continuing with the co-location, I've also mentioned the fact that multiple traders come along and they say we want a different ordering engine. In the best possible world, this could look something like that, where you have two separate ordering engines sitting in the same co-location, and possibly even sitting on the same machine, right? This makes communication between them real small. The configuration is relatively simple, but of course, in the worst possible case, it's actually going to be sitting in a different co-location. And guess what? These guys still have to talk to each other. Another problem that you start introducing at this point is if you end up having two different exchanges that trade the two different symbol that trade the same type of symbols. For example, you have two equities, things that are shown here, and you want to start referring to buying two different equities on different ones. The question is, how do you route those? How do you get the appropriate buy and sell signal to the appropriate exchange? Some real simple naming conventions have evolved, some real complex symbology systems have evolved, and hence you have the introduction of the symbology servers that sit on each exchange and cache these things, because they need to be able to relate in a very, very fast way what symbol on what exchange relates into your particular system. Not only do they have to understand that, they have to do it very, very fast. And the reason for that is you also have to be able to read market data coming in and translate that market data into your internal representation as well. And you have to do this, on the order of nanoseconds. So something else that I wanted to, continuing on the vein of symbology, at this point, we've actually talked about, I think 4 or 5 different components where we have market data, pre-trade risk, ordering engines. We may have multiple ordering engines. We've now got the concept of symbology. As you can see, these systems evolve very quickly to be pretty complex. So people tend to pay a lot of attention to config. To config and symbology is tightly related to configuration because it depends on where things are sitting. So one of the things that I'm trying to show in this particular diagram is that symbology and the configurator, they don't necessarily sit on individual exchanges because those guys aren't responsible for incredibly high throughput or speedy introductions, but they are in some nebulous way responsible for how things are handled on a per co-location systems. Something else that we wanted to talk about is the algorithms, and algos are simply an automated trading strategy. Somebody somewhere makes a decision to buy and sell something. And this is going to happen independent of human action. Human action is really going to be, starting and stopping stuff. There are 2 kinds of algorithms, right? There's going to be the fast algorithms that you want sitting as close to the exchange as possible. And they're going to be the slow algorithms, such as hedging. That, again, it doesn't really matter. You can have that in your offsite, which is your offices. Before we continue with algorithms, though, I want to give somebody an example of a high-speed algorithm. So we get, I know what everybody knows what an algorithm is, but let's look at an algorithm in terms of an exchange or of a trading system. So the one that we're going to be looking at is an arbitrage. For anybody who doesn't know what arbitrage, that means a risk-free trade. There's no future calculation. I know with 100% certainty that there's no possible way I'm going to lose money on this particular trade. And this is a really well-known algorithm. What I'm going to be doing is talking about buying a future on the CME, and then based off of that information, I'm going to, buy an ETF that's sitting on ARCA or BATS, 1,000 miles away. Since what I do for a living is buy and sell futures, right? I know that the gold ETF is tied to the actual underlier, to actual gold, by division of 100 plus $2 here or there or something of the sort. And I know that very simple equation. And I also know that since I have to go out and buy an extra contract of gold that's going to push it from 1200 to 1201, I know as well as the day that I'm born that the ETF is going to go from 114 to 114.50. I can't buy the ETF beforehand because I may not be able to get the gold at that particular price. So this all has to happen after you take care of your primary symbol, which is the future contract in gold. In this particular instance, speed really matters. You have a round trip time of 14 milliseconds from ARCA to the CME. So you have a 6.4 millisecond time for a single particular leg, but everybody's going to be receiving those messages at the same time, which is why everybody suddenly got interested in this microwave transmission methodology. It gives me 4.14 milliseconds single leg travel time. This means that once I actually get the confirm of the gold buy, I now actually own the underlying. I now have 2.2 milliseconds to send and receive the message over radio frequency, do my pre-trade risk limit, send the order to the ordering interface, and the order interface is going to take care of translating that and getting it off into the market. Sometimes you're fast enough, sometimes you're not. But in general, this is a pretty well-known algorithm and a quite profitable one at that. So now I'd like to move on to talking a little bit about market data. Market data, there's a couple of things to be said about market data. Number one, in general, they are disseminated within the colocation by a multicast. And number two, this is a really big thing, is that there's lots of it. So if you have each of these different components are hooking into your multicast channels, they are going to be very, very busy components. There's about 6,000 equities, actually it's about down to 5,000 equities right now in the US alone. They, in general, are published by ticker range. Exchanges go out of their way to not segregate things into fast-moving and slow-moving equities. They try to be as fair as they possibly can and give you ranges of A to M and N to Z, or individual spreads, or there's tons of different configurations for that. And then again, the last thing is there's lots of it. BATS reported in 2014 that they had an average of 22,000 messages a second and a peak of 500,000 messages a second. And again, this is on equities only. So whatever system you have to deal with market data has to be able to deal with these kinds of numbers, which is why people suddenly introduced the concept of pricing engines. I don't want to talk about every possible pricing engine out there because they come in every possible flavor, deployment methodology, architecture, concept, and range. And instead, what I want to talk about is some basic underlying concepts that the pricing engines do. Number one, they clean up data. Number two, they establish their own multicast channels. Number three, they establish their own ticker plan. And then number four is they figure out how to send stuff over long lines. What does each of these mean? Sorry, I'm going to explore what each of these means sort of right here. So cleaning up data is a good example. So let's say, for example, that I have an algo strategy that doesn't really care about sizes. Whatever algorithm that I've developed only cares about prices. So if you look at these two individual ticks right here, you'll see that the prices themselves haven't changed. The only thing that actually has changed are the sizes. In which case, the pricing engine can make a decision to not publish that. These are real prices, by the way. I got these from the ticker Apple, I believe it was. So your pricing engine can make a decision not to send these particular things out because the information of interest hasn't changed, and therefore I'm just going to be polluting my system. And another thing that I want to bring up right now is if you look at the actual prices. Oops, why is my right here, the bid and ask, you'll see on the bid size, it just keeps thrashing. It goes from 56 to 55 to 56 to 55, 55, 56, 55. This is literally built, and it's not necessarily our algorithm. There can be two competing market makers out there that have thrashing algorithms, and this is going to be driving our internal systems wild, right? You're literally, every time you move, if you're in the business of, say, for example, pricing options, where you price, 2,000 or 3,000 different instruments based off every single tick. Every time I see one of these things thrashing, I'm republishing 2,000 or 3,000 different messages because of a thrashing algorithm. This is something that I'm going to be real interested in cleaning up. Establishing its own multicast channels. In general, unless you're a market maker, you actually only care about individual groups of symbols. So let's say you only care, for the purposes of this example, about 500 symbols out of the 6,000. Right? Then it should be very easy for my pricing engine to take, any symbol off the wire, turn around, figure out what new multicast channel it has to be sent out over, and publish that. So I've actually just reduced, 80 or 90% of the messages thrown through my ecosystem simply by filtering out, what messages are going to be published, and therefore not overburdening any of my algo engines, my risk engines, my pre-trade, my position engines, or any of the other ones that I've spoken of right now. I'm also going to be able to create different multicast channels for low latency applications versus non-low latency applications. And some of the fancier ones can dynamically create and destroy multicast channels based off of what a particular algo is doing and how much they communicate with each other. But those, again, those fall into the fancier categories. Another thing that your pricing engine is going to do is it's going to store all your data into a data plan. This is not the hardest thing to do, but it turns out it's relatively important for testing your strategies. It's as simple as taking your data and slapping it into a CSV file or slapping it into a database so that you can recover it and restore it previously. You can look for very specific cases. You can replay it at 5 times the speed. You guys can figure out what the back testing there is. But this one is important. It's cherry picking what information to send over multicast to your internal ecosystem that's sitting on your co-location versus long lines. What we found is multicast is very, very, very reliable in data centers, but not very reliable once you try to send it across data centers. So one of the functions that pricing engines do is they pull the update from a multicast and translate it into a TCP packet and send it point to point so it can be disseminated again in multicast in a different data center. And I got ahead of myself there sorry. I was talking about that. And then one more thing that pricing engines do is that they can, and depending on the guide, they can create their own prices. This can be as quote unquote simple as pricing options, for example, or you can actually start creating your own instruments. Say, for example, I'm real interested for whatever reason in all the Ma Bell companies. Right? I can create a Ma Bell basket that contains 4 separate underlying instruments. It's AT&T, Bell Atlantic, something else, I forget what it's called, and then come up with something as easy as a weighted average in order to create that basket. And now I can treat that basket as an individual instrument instead of having to treat them as 4 different instruments. And again, that creates a lot of problems because those are relatively liquid products, and those products are ticking at 4 times the amount of any normal product in the worst possible case scenario. So how do we integrate the pricing engines and the market data that we were already talking about? The picture becomes relatively simple. Simply now we're filtering out all of the messy data coming into our ecosystem because it's going through a pricing engine. We greatly reduce the line detection. We figure out how we're going to send it to long lines. And what's even more important is once we figure out what pieces of information are salient to our overall ecosystem, we can now start creating what's called a consolidated price feed. And that consolidated price feed, all it does is it takes in price bids and quotes and trades from separate exchanges and consolidates them to provide any of the particular schemas we want. We can provide BBO across multiple exchanges. We can provide MBBO across a certain set of exchanges. And believe it or not, I've actually seen algorithms that want the worst best bid offer, so it's a WWO or something like that, where they were actually looking to find imbalance. Like you can come up with any of the algorithms that you can think of. Now that you can compare multiple exchanges, you can come up with that on your own. Things get particularly interesting, though, since right now these pricing engines are feeding our ecosystem, our algorithms, but it turns out they can also feed other pricing engines. And unfortunately, your consolidated pricing engine can feed itself. So, you know, this level of recursion in general makes life difficult, and this is an exception. Oh yeah, and you're consolidating price feed, but in general, your slower algorithms are going to take their cues off consolidated price feeds simply because they have a more complete view of the world. But that's not necessarily the case. And that sort of leads us into the reporting, since we're sending things across lines. I'm sure people have heard of the topic or the acronym FINRA a lot, and it stands for the Financial Industry Regulatory Authority. And it was set up and is continually funded by self-regulatory organizations. Basically, a whole bunch of organizations got together and they said, we don't want the US government sticking their noses in the financial world, telling us what we can and can't do, and, you know, creating this incredibly large democratic bureaucracy that is basically going to slow everybody down to molasses. So what we're going to do is we're going to regulate ourselves, and that's an SRO. Of all the people on this diagram, only one of them is eligible for being SRO, and that's the exchange. There's no way that the government's going to let banks regulate themselves, but exchanges can. And that's where the concept of these fair trades and how and how reporting is done and why reporting is done is brought up. They're the ones who actually regulate that. And they're the ones that fund FINRA, along with a lot of big banks like BAM, Goldman Sachs, and a few others. Some of the reports that everyone's heard thrown around, these are the two most common. So it's LOPR and OAPS. LOPR stands for Large Option Position Reporting. I forget what the exact number is. Actually, I'm pretty sure it's 200. And it says that if you increase or decrease the size of your options by more than 200 at any given point, you actually have to report that to the regulatory authority. And then for any orders, trades, executions that you do on an equity system, you actually have to report that. Unfortunately, the reporting lines aren't as simple as you would expect. They look a lot more like this, where the exchange is doing a drop copy, not just to the internal trading house that place the order, but they're putting a drop copy into the exchange. They're doing an OATS report to FINRA itself. Your broker is doing an OATS report to FINRA, and the individual trading house is doing an OATS report to FINRA. FINRA then stops and compares all of these and tries to find a discrepancy. If there is a discrepancy, they give you a call. If there isn't a discrepancy that you plug it on, and then they audit you every 6 months to see what your systems look like. So as a quick recap of the stuff that we've talked about right now, we've explored the concept of ordering engines that translate between the internal ecosystem terminology and the external world. We've talked about pre-trade risk, which helps you determine what you trade, how you trade it, and if you're allowed to trade it. Your algorithms that determine if you should indeed be trading, which is something that everybody here is going to be interested in, right? Because that's sort of what the sentiment analysis is going to be impacting. Your position manager, which is basically your big account within the ecosystem. Your pricing engine that helps clean up the data, publish it to the internal ecosystem without driving all of your systems crazy. Your config engine, because already you can see how complicated this is going to be managed to be configured. A reporting generator that has to help send your reports to FINRA, and your symbology server that helps you differentiate the same symbols across multiple exchanges. And that's sort of the end of the first presentation, the front office stuff. Like I said, I was going to break this up into two separate ones. And so these, like I had spoken with a few people, and they were very interested for me to give a 20-second thing on pre-trade risk. And also when I was starting to build out the ordering interface slides, this was a slide that I threw together in 5 minutes. This is the most basic order state that exists in ordering engines. And this is ignoring just about 80% of all the functionalities of ordering engines out there. It ignores timeouts, auction states, special instructions, special types, smart order routing stuff. But as you can see, like the most basic one, isn't a simple, I got filled or I didn't get filled. You have to deal with a lot of different possible states, and there's a lot of concurrency in there. Like I mentioned before, all of these systems are very, very chatty. So we have to be able to deal with lots and lots of messages sliding through the system. And it's not only the messages that are going to and from the exchange that we're going to be interested in. We're going to be very interested in the number of messages that get rejected from pre-trade risk. We're going to be very interested in the messages that contribute to two different accounts, to be able to provide those kinds of analytics to any of our customers. So these are a couple of examples of how pre-trade risk engines are sort of taken care of. By the way, most of these things are written in either C++ or standalone Java applications. Two of the simplest possible examples that you can deal with it, and probably the most common that I've seen, is sort of splitting the difference. Remember how it said that there's two colos, NY4 and MAWA, and all of the stuff has to flow through. I was supposed to say 8. It's 111 8th Avenue, not 9. Sorry. So instead of actually sticking your pre-trade risk engine in a separate colo and giving all preferential treatment to an individual one, there's no reason you can't throw it in the Equinix data center. And then you cut all of your round trip travel times down by half. And you're treating everybody just as unfairly. It's not the ideal situation, but it's certainly better than having your message broker sitting locally with a different risk engine in a different data center than the guy actually requesting it. Some of the more complex approaches that I've seen is the distributed approach, where you end up having two different risk engines sitting in different co-locations, serving the same instrument, the same symbol. So Microsoft or USO or the Qs, for example. And then they have one of the more interesting approaches that I saw to it was, well, the basic approach is like when you run out in your individual colos, you're out. Like we've allocated a certain amount that can be bought and sold in that colo, and that's you can't trade anymore. And some of the more interesting approaches that I've seen is where these guys start sharing resources or stealing resources, which means as one of the servers that's designated as a primary server approaches its limit on that particular instrument, it will then go and steal resources away from any of the other servers that are going to be filling out that instrument. And as you can imagine, this sort of gets a lot more complex once you set up the following the Sun offices, where you got offices in Asia Pacific and Europe and the Americas, and they're all trading the same instruments on different markets, and you end up sharing stuff, on a live ring. And like I said, things get really interesting when they're happening at the same time, because not only do each of these bubbles represent a continent, you've got multiple different co-locations inside the continent itself that are talking to each other. Look at. And then simply, I felt bad about the fact that I stole Bats' graphic and literally cut out a whole bunch of their stuff, so to put on one of my own slide. So I just threw their slide up there at the end. Which, again, this is easily findable on the web. Bats is actually one of the most transparent of all the exchanges about publishing their numbers, but they do it for a year -1. So you'll find all the numbers for 2015 and 2014, but no numbers for 2016, since they don't want to give any competitive edge away. That's it. So, any questions? Nobody asked me to repeat anything, so that's good.